Good morning and welcome to day two of the ACT's International Treasury Week. The main theme for today is going to be about planning for business volatility, and we're starting with a discussion which is focusing on the role of corporate banks in how we're going to try and manage those survival strategies through the rest of 2020. This morning I'm joined by three far more qualified gentlemen than me. I'll start off firstly just by introducing myself and then handing it over so everyone can introduce themselves. My name is Brian Shanahan. I'm not a corporate banker. I'm a working capital consultant running a company called Informita, and I help out with the ACT in various events, including the annual Working Capital Conference that we hold usually in November, December. Yep, that's me. Daniel, do you want to start?
Sure. Morning all. Daniel Cichocki, Commercial Finance Director at UK Finance, which is the trade association for the banking and financial services industry. So representing the entire spectrum of lenders, everything from the large international banks through to specialist lenders, mortgage lenders, payment service providers, and invoice finance members. In our role as a trade association, we've been working very closely with our members, government and other business groups over the last few months to really mobilise the government support and guarantee schemes to support businesses through this challenging time. I also run our LIBOR transition programme, and in that capacity I've worked very closely with colleagues from the ACT over the past few months, and so that's me.
Okay. Paul?
Yeah. I'm Group Treasurer of Shawbrook Bank, which is an SME challenger bank. We focus on buy-to-let loans, SME loans, and also some consumer loans. We've grown from around 1.7 billion when I joined in 2016 to about 5 billion of loan book right now. And I'm also formally the president of the ACT. As of a couple of weeks ago, I'm now immediate past president.
Thank you. Mark?
Yeah, good morning, everybody. Mark Tweedie. I am responsible for the corporate bank in the UK at Citi. So in that capacity, we cover clients that are domiciled here in the UK, be they corporates, financial institutions, or indeed the public sector entities of the UK government and the NGOs, multilaterals that are also based in the UK.
Thanks, Mark. Just a few housekeeping tips before we get on. There is an audience Q&A facility that you'll see either on your app or online if you're logged on that way. The session is being recorded, so if for some reason you have to leave before the end of it, you can always come back and listen to all the things we were waffling on at some point about. There is also a discussion forum afterwards, separately, for any feedback that you may have on the session itself and how we've conducted, because we're always trying to learn how we can do things better. And lastly, don't forget our good friends in social media, Twitter and so on. The Twitter handle is @ACTIs and the hashtag is ACTITW. Right, okay, that's all the housekeeping out of the way. I'm going to start with a question and see who jumps in first. Yeah, I mean, in recent weeks we've heard all sorts of stories in different countries and different governments about various schemes to support either big business or small business. You know, obviously, well, it has happened that banks have been heavily involved in effectively executing those schemes. I'm just wondering, what the reaction that you've seen from businesses to these schemes and how they're operating.
Yeah, I mean, I think happy to jump in there, Brian. In terms of the context, it's important to bear in mind that the vast majority of finance support that's being made available by the sector through banks, non-banks, and other lenders is being done on normal commercial basis and has been done throughout the crisis. It's important to recognise that all remains in place, and the industry's got very significant capacities to ensure that continues. The government guarantee schemes have been very important additive areas of support to allow the industry to continue to sustain availability of credit for businesses of all sizes. So I think what we've seen over the last few months is a spectrum of schemes build up to try and ensure that everything from the very smallest businesses, which we saw through the launch of the Bounce Back Loan Scheme last week, very successful launch of that, about £5 billion lent through that scheme for the smallest businesses in the UK. We've got obviously the coronavirus business interruption loan scheme, which has probably been the one in place the longest and perhaps had the most attention, but providing facilities of up to £5 million for SMEs with a turnover of up to 45 million. The Bank of England scheme, the CCFF scheme, obviously very important for some of the large corporates, providing those businesses, providing a material contribution to the UK economy and of an investment grade kind of access to a commercial paper scheme. Again, very significant volumes being lent through that. So I think the last figures, I think, were about £17 billion provided through that scheme. And in terms of closing that gap then that was left between the civil scheme and the CCFF scheme, a larger civil scheme was launched a few weeks ago for businesses of anything over a turnover of £45 million and above, providing facilities of either £25 million maximum or £50 million maximum, depending on the turnover of those businesses. So what we've now got is a spectrum of very different schemes with very different purposes for very different segments. And I think they have been mobilised at unprecedented pace. They are, as you can imagine, have been complicated to deliver, complicated to agree with the relevant authorities, whether that's the Bank of England, CCFF scheme, or the British Business Bank and Treasury on the other schemes. But they have all been additive to what is and has continued to be the core function of the banking industry, which is providing finance facilities on normal commercial basis, which has continued to flow throughout this crisis.
Mark, what have you seen?
Yeah, I'd concur with Daniel. I think we've seen it through three lenses, and at Citi specifically, I'd place my comments predominantly in the CCFF area, given the nature of our client base. They tend to be the larger, MNCs, multinationals, the mid caps and above. So we've seen it through the lens of lender. In that way, we saw fairly significant drawings, so conversion of our unutilized committed facilities into gap assets. And that's important for a variety of reasons for the bank, not least, as I'm sure Paul will explain, from a bank treasury standpoint, from the management of our own balance sheet, our asset liabilities, but also our stress loss provisioning. And so we saw that up front. We saw a number of clients wishing to draw down on the revolving credit facilities. Where we are in a position as a core lender within the syndicated facilities, we've been called upon to provide attestations as part of the eligibility criteria that where a corporate is unrated but deemed investment grade by the bank's credit committees, we can provision that client, that applicant, with that attestation. So working hand in glove with the Bank of England, the Sterling Markets Division, to ensure that us participating in that capacity was in no way compromising our duty of care in terms of non-public information, was a key ingredient. And managing, as I say, the balance between CCFF drawings and commercial bank lending facilities. Secondarily, we've been heavily involved as a dealer in the CCFF as a CP dealing bank. We've seen a terrific uptick in the sterling CP market relative perhaps to the US and the euro market. In the context of the government CCFF facility, which has seen somewhere in the order of a 3.5 to 4-fold increase relative to the equivalent US program. As an agency bank, we are a paying agent for a number of other dealers, and so we've seen firsthand that money flowing out and managing those flows at a last mile execution agency and trust level. And so as Daniel has observed, it's been a critical ingredient in what has been a broad armory across the central banks, the commercial banks, and laterally the capital markets. And it's been helping guide clients and working with clients to access the profusion of options that are available, be it commercial CP, CCFF, or indeed debt capital markets. And as we transition further in the 8th week now of COVID-19, there's increasing focus on equity recapitalization of companies that want to maintain leverage below certain levels. I'll stop my comments there.
Yeah, probably worth adding, I know it seems like a little while ago now, that there's been pretty extensive take-up of payment holidays by SMEs. and by individual customers. So in the buy-to-let space and the SME space, we've seen very extensive take-up of payment holidays effectively as a stopgap on cash flow for small corporates.
Thanks. I mean, one of the things certainly people I've talked to in recent weeks that they're worried about with all these schemes is that we're simply giving more debt potentially to companies that may have gone bust anyway. And the other thing that seems to be the case, and I'm not an expert on this, is that it seems to be in different countries, the way banks approach this in terms of provisioning and so on seems to be quite different. Mark?
Yeah, I mean, I think every bank will come to its own conclusions around its cost of credit provisions, and you saw the US banks 2 weeks ago with their Q1 earnings, make anything between 4 to 6.5 billion of incremental credit loss provisionings, and that will be contingent on the nature of their loan book, dependent on the sectoral exposure they have. There have been clearly some sectors worst affected, first order being aviation, consumer discretionary, cruise lines, subsequently autos, and then with the OPEC plus Russia commodity price dispute and the contraction in demand, we saw the natural resources sector impacted. So each bank will make determinations based around their own asset base and the security packages they have around that. But certainly you've seen quite an uptick in Q1, not just amongst the Americans, but also I'd call out the UK banks in particular, who recognise early the adverse consequences and the fact that it's really only hit the OECD countries in March, where the majority of the assets are in play for the majority of banks. And so Q2, we may see more to come.
Okay. And Daniel, what have you seen on this particular front or have an opinion?
So 2 points, I suppose, to your question. One around the comparison with international peer examples. Clearly, I think in the early days, the rollout of the CBIL scheme for SMEs in the UK was probably compared unfavourably to particularly Switzerland and Germany, where there was clearly credit being made available through the scheme rules set in place in those countries much quicker than was possible under the scheme rules in the UK. What we've seen throughout that has been a response from government, the official sector and the banks to adjust to what's required. So the launch of the Bounce Back Loan Scheme was actually a response for the very smallest businesses who want to be in a position to have access to credit very quickly, a much simpler application process, 100% guarantee from government, and a much more self-attestation approach versus sort of bank affordability checks, which was the approach taken in the early days for understandable reasons. So we've always been, throughout the period, comparing the UK to our peers and credit, I think, to the government and to the British Business Bank and Treasury in particular for adjusting where required the schemes, where there were gaps emerging, where we were comparing perhaps unfavourably with our international peers. And certainly I think the Bounce Back Loan Scheme will help for the very smallest businesses from that perspective. In terms of the affordability, all of these schemes have really been put in place not to provide debt to those businesses that were already unviable at the start of this disruption. All of these schemes have been put in place to support provision of credit to those businesses that would have been viable but for this disruption. And they're all a reflection of our collective interest, really, to make sure that businesses that were good, viable businesses before this crisis can trade their way through and trade their way out of this crisis, and that we don't lose good businesses as a result of what is a very short, very painful, hopefully very short, but very painful contraction in the economy and in certain sectors as a result of what we're seeing on the medical side of the response. So the schemes have been designed with that in mind. So there are particularly for the CBILS scheme and the larger CBILS scheme, there is still affordability checks and viability checks being done by the banks. They are being done on a proportionate basis. So I think we've seen commitments from the largest lenders to say we won't seek to require the same level of documentation we normally would to assess that viability and affordability that we would have done pre-crisis, but we'll rely on the information we already have as lenders to try and do that. And they're all trying to do that on the basis of looking back at the business's financial position at the point of the disruption commencing, accepting that in many cases cash flows will be very significantly disrupted, and in some cases will simply cease for a short and sharp period. So all of the assessments of affordability are being done on that basis, but they are still being done as you'd imagine, as responsible lenders and as the scheme rules require. So there is a balance that we're trying to strike here, which is maintaining flow to credit to good, viable businesses, but equally making sure that we are doing as a sector the responsible thing in making sure that businesses can afford to take on the level of debt to see them through this crisis. And that's the balance we're continuing trying to strike.
And I think Daniel, just to sort of follow on from that, Daniel's right that sort of balance is the right word, because bank boards have a responsibility to provision conservatively, but also I don't want to use the word unprecedented because that seems to be used in every sentence by every person these days, but we're in a period where it's very difficult to make assessments. We have borrowers on 3-month payment holidays who are not paying late, and normally if a borrower went on a sort of 3-month period where they weren't paying back their loan or paying interest, we'd start to look at that as an escalating risk of default. But this is effectively a mandated payment holiday, and we have to sort of take a step back and realize that the borrowers aren't going to be in late payment until that three-month payment holiday is ended. And then only after another 3 months are we going to be able to make some kind of proper assessment as to how we should appropriately provision. So it's a matter of bank boards being conservative, but not shooting too high in terms of provisioning and risking sort of constraining the capital they have to lend to other businesses, but also, of course, not shooting too low and hitting the right level of conservative provision so they're not sort of giving the wrong messages to the market. I mean, there's been some criticism of IFRS 9 prior to the crisis, and also I think what's been brought out by this crisis, in that effectively requires provisioning almost for the life of a loan. Even if you have a long loan that will only default towards the end, it doesn't recognize any income. So effectively it's an extremely conservative standard, but almost is acting like a counter-cyclical capital buffer, or rather, sorry, a cyclical capital buffer as opposed to the counter-cyclical ones. So it's reducing banks' capital right at the time when the regulators want it to be stabilized.
One of the things I wonder, Paul, is many businesses under normal circumstances are quite wary of debt. Yeah. For those businesses that traditionally don't engage that much with debt markets and so on, I'm sure there's a number of them who, quite frankly, should be applying for these kind of supports who may not be doing so. And one of the things that, in my mind, is, for those people who don't directly engage, how are they supposed to find out about these things and be encouraged to say they actually should participate in kinds of schemes?
I think sort of the first step for businesses that don't normally take on debt or don't normally engage with debt is to do their ACT basics. Coming back to the sort of Association of Corporate Treasurers, do your cash flow forecasting. Look at your business performance history, its cash flow, its what level of debt it can service in terms of its income before the crisis. And you have to try and make some assessment of what's going to happen after the crisis, and assume sort of certain periods. And on that basis, you can make some form of assessment about what level of debt you can take on and what level of debt you can service. Obviously, we we're in a fairly fortunate time, or in terms of interest rates, that will allow you to service debt on a lower cost basis than would have been in previous crises. So it is a matter of doing your, as I say, doing the corporate basics. Forecast your cash flow, forecast your funding, your liquidity, and how much you have in the bank, and let that be the sort of guide for your assessment in determining how much debt you can take on.
Yeah, I mean, we know that pre-crisis, about half of all SMEs in the UK were not borrowing, expressed no interest in borrowing, and had no experience of recent borrowing. So I think we've seen a lot of those businesses seek to apply for finance for the first time. I think particularly for that cohort, the bounce back loan scheme will be very important, and the process, the simplicity of the process will be very helpful for that cohort. But there's also a separate cohort, which are those businesses, perhaps larger SMEs, perhaps those in the mid-core that actually were borrowing, were using external finance pre-crisis, but actually had to draw down further facilities, apply for further facilities. And actually the question about how do you manage the sustainability of that debt post this crisis, I think, is starting to come onto people's radar, and is probably more of a challenge, or more of an acute challenge, than perhaps some of those SMEs, many of which in that sort of permanent non-borrower category actually had fairly significant cash reserves going into this crisis. And while we've seen those being utilised, I think taking on borrowing was more of a attitudinal thing pre-crisis, now is being taken on, but it's probably perfectly affordable in many cases. But it's probably those businesses that were already utilising external finance and have continued to draw on even further external finance, probably is the cohort that we should collectively be giving most attention to. What does managing our way out of this crisis look like?
I think there's an interesting question there for small corporates, that in what Daniel said. If you already have a fairly reasonable cash reserve, at what point do you go to your bank to access debt? Do you do it earlier, before that cash reserve is depleted, when the bank's got to make an assessment and say, look, the business is in a much worse state than it was before? Or actually make your application a little bit earlier, when the business looks stronger and you've got the sort of historical position and the existing position to fall back on? Mark might be able to comment better on that.
Yeah, I mean, I think the time to access debt is rarely when you need it most, the best time. I mean, it's simple principles, but I think we've seen that very clearly for clients that are in the process of refinancing or amending, extending their existing credit facilities during this crisis. It's been a less seamless process than it would have otherwise been, and that's because a lot of banks are looking very hard at what all the change in profile of their their borrower base has meant for them. Clients that are very reliant on uncommitted trade finance facilities, have seen increased liquidity premium pricing, have seen some withdrawal from market participants in distributed short-term paper. There's been repricing in the market for network lending. And then as clients come to access incremental facilities, bridges, short-term RCS, term loans, etc., at this time, banks have been understandably discretionary and selective about participation levels. So, we've seen some very interesting evidence across some of these big COVID syndicated facilities around bank selectivity. And you're going to see that because banks have to manage their industry limits, their sovereign exposures, their obligor exposures. And so you're going to start seeing some understandable selection and deselection. But clearly, it's better to access in more benign markets than it is to access at the peak of the credit spread spikes. But as I think Paul mentioned, the long-term interest rate environment, at least from a debt service standpoint, it is beneficial. I mean, Mervyn King was on Radio 4 this morning recognizing the fact that, the UK's debt level is sort of overshot forecast pre-2020 by 4 times because of all of the provisions that have been made. But the benefit that the country has is A, the accessibility to the gilt market, and B, the fact that servicing that debt over time is a tailwind rather than a headwind at the present moment.
Another thing that I wonder is that, all of this has happened very fast. And Paul, you used the word earlier, unprecedented, that we're probably all trying to avoid at times. Yeah. But put it like this: banking institutions are not known for making rapid change. They're very complex organizations. It's very difficult oftentimes to do that. That must be an immense challenge over the last 8 weeks to respond to all this in a way that, I suppose, to make sure that all these schemes, loans, whatever difference in attitude and so on to corporates, that must have been an immense challenge, and probably continues to be an immense challenge. I just wonder what you guys are seeing on the ground.
Yeah, colleagues from institutions may be able to share experience of what it's been like for individual institutions. But looking across the industry, it's actually been phenomenally impressive to witness really the redeployment of tens of thousands of staff from offices to remote working on an unprecedented basis, to use that phrase again, while maintaining 90% of branches still being open to serve customers who require face-to-face interaction, redeployment of staff from divisions within banks to support the front line in terms of making sure that businesses who needed to speak to banks could be able to do so quickly. It's been pretty impressive to witness across the industry that mass redeployment, as well as suffering across the industry exactly the same challenges that every single other business is facing at the moment, which is the care responsibilities that individual employees have, self-isolation, indeed many colleagues suffering from the virus itself. So at times we've had absence rates of 20-30% across the industry. So not only to redeploy BAU en masse to serve customers has been pretty phenomenal, but on top of that, to roll out enormous, unprecedented government guarantee loan schemes at the same time has been, I think, pretty impressive to see, and I think testament to the commitment that the industry's really got to making sure that we're part of the solution to this crisis rather than being part of the problem in the way that we were to the last crisis.
Yeah, I think there's been a benefit for organisations that were maybe forward-looking and put in more flexible working arrangements for their staff ahead of this crisis, obviously without knowing it was coming, but just for general work-life balance, sought to allow people to, say, work from home occasionally or work from home 1 day a week. That's actually served those organisations very well in that they've been able to revert perhaps much quicker to remote working. Whereas the traditional sort of disaster recovery model for a lot of organisations in the banking sector used to be that effectively you had a head office site and you had a secondary site where a lot of essential staff would move. And that's not been an appropriate disaster recovery model. Those that were still on that model are found it difficult to cope or have had to sort of rearrange the things quickly. And whether you say the flexible working thing is, if you're cynical, you could say that's just not enough desks for people, and they've been making a cost saving there. But it's definitely been a sort of a benefit when we're looking at the operational capacity and reverting operations quickly in response to this crisis.
Brian, if I may, I'd probably challenge that sort of perception as well a little bit. If you think about the last, just take 5 years, the changes that the financial services sector has had to implement and respond to, both sort of retrospectively and proactively around sanctions, the imposition of sectoral sanctions, changing the nature of how we apply the lens that we are beholden to people like OFAC as conflicts have arisen geopolitically, has increased massively. Faster payments in the cash management space, the move from sort of ACH, real-time gross settlement, to faster payment schemes in 37 different countries. We've seen MiFID 2, we've seen PSD2, we've seen SEPA. There has been a raft of growth in the private markets. And so as a bank that has a huge back and middle office around market securities, clearing and custody, the switch to ETFs and algo traders, as well as sales and trading activity with multi-bank platforms as opposed to bilateral voice and over-the-counter trading, has meant that the financial services sector has had to be on its game post-financial crisis and has had to really retrain itself and build muscle mass in agility. I really don't want to sort of stand here as the big spokesman for the GSIB banking organization, but I think that the banks have absolutely changed in terms of the speed of response and are quite used to being the practitioners and executors of government policy in different ways. And lastly, that's also partnering where historically there might have been view of hostility and competition, the move to sort of co-opetition with the fintechs and the non-bank sector, and how you can support and enable those has grown exponentially over the last few years. So I don't think the banks come into this with a particular weakness in adaptation. I think Daniel made an excellent point that we want to be part of the solution as opposed to the legacy perception, which is the originators and the problems. We really want to work very hard here to make sure that we're delivering for society and for Main Street to make sure these policies work, and fundamentally to keep good businesses alive and well. And that's where there is massive mutual interest and alignment. And that can come in covenant waivers, it can come in refinancings, it can come in accessing capital markets, but fundamentally the needs of the corporate treasurer and the banks. Yes, there's going to be areas at the margin, at the periphery of friction. There always will be. But, by and large, our needs are aligned here.
Yeah, I think it's that there is banks' operations have coped very well, as Mark says, but there are fundamental sort of things that banks need to balance in terms of the speed of their operations. Regulatory requirements like anti-money laundering and know your customer checks against actually speed of just taking on a new customer. Things like providing credit versus affordability checks. These are regulatory requirements with heavy penalties for banks, so they have to do them properly. So I'm never want to sort of try and elicit sympathy for the banking sector. I know there's not much of it out there, but probably also worth saying to corporates when you're looking or seeking facilities, before you approach your bank, be ready with every piece of information that they will request. You know what they'll request accounts. You know that they will request cash flow forecasts. If you're a new customer approaching a bank, when you've been getting your finance or facilities from a non-bank, that they're going to have to do the anti-money laundering checks. And it's pretty standard what information is required. It's quite easy to look it up. Have that to hand, and that will speed through your application and process.
Yeah, I think it's an unfortunate fact, guys, isn't it, that when we switch on the news, usually the headline item of the day is usually something bad happened rather than something great happened, and it's clear to me that there are an awful lot of amazingly positive things going on, not just from the point of banks, but also from the point of corporates. I mean, I've been dealing with many corporates over recent weeks where 8-9 weeks ago they were fearing the absolute worst, and they're now finding out that okay, things have changed, but the picture isn't necessarily as dark as they thought. Yeah. Now there's exceptions to that, obviously. I mean, if you're an airline, I mean, this is a time of huge crisis, but not everybody's an airline. Yeah. And but it kind of leads me on, because I've got a US colleague of mine, and one of his favorite phrases is that we tend to plan for the crisis we just had. Yeah. And and if you think about it, we're in the middle of something now, and hopefully we're starting to come out of it. But one of the questions from our audience is, well, what happens if we have a second wave of this? Or if the whole crisis is not something that kind of blows over by the end of the summer, but just lasts much, much longer? You know, what's our capacity to actually, you know, maintain this level of support in someone for many businesses for an extended period of time?
Yeah, I mean, I suppose it's worth emphasising that for many businesses, it's the non-bank support directly from government that's been one of the most important collective responses to help them survive the sort of emergency response for the first few months, and certainly the furlough scheme. Again, unprecedented, but it has been hugely important to businesses of all shapes and sizes across different sectors. What the eventual wind down of that looks like and how that impacts certain sectors and business types, and the flexibility that is possibly and hopefully built into the wind down of that scheme, I think will be equally as important to the direct bank support that's being provided to businesses. So it's the direct support from government, it's also the grants to many of these smaller businesses that's critically important as well. So I think there's been a collective response to try and manage the emergency response. What we're now starting to give consideration to is, as you say, what are the various different scenarios that might arise? This may become a more prolonged economic disruption than we'd hoped for. This may be a short and sharp with a successful rebound in H2. It may be that actually many businesses have taken on a very extensive and unsupportable debt burden in order to get them through the emergency period, and actually some equity solutions are where the more medium-term horizon needs to be focused on. So I think all of those considerations are probably important, but none of us know the future. So I think what's happening is that scenario planning across both the banking industry in terms of how we support customers, across UK PLC in terms of what's the right balance between government direct support, banking industry support, and business investment, clearly going to be critical. But we're also starting to see, and indeed many people are actually taking on some of this business debt in order to repurpose their business. So people are thinking about how do you restructure supply chains, how do you seek to adjust your business model for what might be a new normal where social distancing might be quite common for an indefinite period through 2020. So a lot of repurposing starting to happen, and those conversations are starting to happen with bank lenders as well, which is a good sign, I think, but a sign, I think, of the level of uncertainty that we face, and that businesses like banks and like governments are having to do much more in the way of different scenario planning, because we just don't know what exit is going to look like. So we're all starting to have to work through different options and scenarios for that.
I mean, I'm an optimist about people and businesses' ability to adapt to new circumstances. What we've seen in the past couple of months is a sort of typical phase of shock, denial, and then we're moving on to an acceptance phase where businesses are looking at a new reality and figuring out how they can adapt and make their business model work for that reality. And I have incredible faith that businesses will find ways to adapt and adjust. You know, we're sat here online in probably an electronic conference that prior to this crisis wouldn't have been feasible or really thought about, when we were probably all expecting to be sat in Cardiff in large audiences. So I think there is the capability for businesses to adapt and think about how they're going to move forward over the next year or 2 years, with restrictions in place and the possible reimposition or loosening and tightening of restrictions on an ongoing basis for a period.
Maybe my comments I'd add are, our credit strategist certainly points to the increase in leverage across the corporate universe, and the criticality of getting gearing down to more manageable levels, particularly with a rebased cash flow profile and profitability margin profile for a post-COVID, be it wave 1, wave 2, U-shape or W-shape or L-shaped recovery. And I think one of the certainly the encouraging things as a lending officer that I have witnessed through the committees that we've held, as Paul said, virtually over the last 2 months, has been the downside planning and the base case alignment to our own stress test modeling. And I think the prudence that we've seen from most, the vast majority of corporate borrowers has been to allow for such an eventuality, or indeed even if there isn't a second wave, much reduced, be it footfall in retail or adoption of discretionary spending practices in the services sector. So I feel people are planning for it. Having said that, it's notable, particularly in the largest capital market, the US equity market, that the stock market went down a third between March and April, and then recovered 50% in April. And that a huge amount of that was to do with the purchase programs and the Fed stepping in, not just for investment grade, but for non-investment grade and high yield issuers. And a huge concentration of that was in the sort of all-weather stocks of the FANGs, the tech companies and the biopharmaceutical companies. So there's massive dispersion. And certainly there is going to be heightened vulnerability in certain sectors. And I think my closing comment is this: it's undoubtedly a learning of COVID-19 that the world needs more resilience. We need more resilience in terms of equity resilience on the balance sheet. We need more resilience in terms of our healthcare systems and the net present value of future spending on the healthcare systems that are certainly going to have to increase. We need to be able to sustain this, because for the world to be brought to its knees by a pandemic of this nature, the respiratory virus pandemic, just underlines how vulnerable, and I think it was Daniel that talked about the supply chain, how vulnerable the current way of operating is. So there's no doubt this virus is going to have whilst we talk about it slowing life down and birdsong and less carbon emissions, it's going to accelerate dramatically some of the big themes around technology, innovation, some of the geopolitical tensions around reimagining your just-in-time inventory position, your manufacturing supply chain. That is definitely going to change, and it would be utterly irresponsible for banks not to ask those questions of the boards, and for the boards not to be thinking about those things. And that is certainly what we're seeing right throughout corporate Britain.
I think you're absolutely right, Mark. I mean, this is kind of my usual day-to-day bread and butter, and one of the huge subjects at the moment for corporates is supply chain risk, where in the last 20 years we've piled everything into low-cost countries. Why? Because the capacity is there and it's cheap, which has had enormous benefits for lots of people. But of course, we've put an awful lot of eggs in one basket, and we are seeing some of the consequences of that. And I think the next 3 to 5 years, we're going to see massive revolutions in either one, moving to some low-cost countries that no one has ever even thought of moving to before, simply because they want to diversify the portfolio of operations. And the other thing is going to be around industrial automation, which has been around for years, but of course the cost is rapidly falling, versus the labor arbitrage thing. And of course, that will completely change the nature of the way trade finance operates, because we'll be different in different countries. Mark, you mentioned earlier about geopolitical risk, totally changes that, and so on and so forth. So I see there's a lot of changes coming up in that particular sphere. But just imagine you are a corporate treasurer today, and you're listening here, and you've probably gone through the last few weeks, and you've done your scenario planning and your cash flow forecasts, and you probably have a pretty good idea, are you going to fall off that cliff or not? If it's a thing that someone has not already accessed, either some of these government-sponsored schemes or just regular banking lines or other innovative things that they can do, I mean, what are the kind of things that those corporate treasurers should be doing right now?
I mean, it's a very, very simple message, but speak to your lender, speak to your banker lender, speak to your relationship manager, speak to contact points that you have with your existing finance providers. The first few weeks saw an absolute, as you can imagine, inundation of bank call center, enormous volumes, very, very stretched relationship managers That has eased off slightly in the last few weeks. There is more capacity to have some of those detailed conversations about your specific needs now in place across the industry. There's a lot of very, very good information online, particularly if you want to understand the government loan guarantee schemes. The British Business Bank's website has very good information for businesses interested in exploring the right potential schemes for them to explore, and details of those lenders that are accredited to deliver those schemes. And more banks and non-banks are becoming accredited week by week for those schemes. But again, as I said in my introductory remarks, the vast majority of support continues to be provided on normal commercial terms with pre-existing banking and lending relationships. So I think it's a case of the sort of conversations that can be had constructively with relationship managers. Normal contact points are probably the best place to start.
Paul?
Yeah, I would echo that. I would. I mean, if you have all that information to hand in a really good format, you're generally ahead of the game. But I would emphasize making sure you have good communication lines with your frontline business, sales force, product teams, HR, just to make sure you have a full picture. And you're getting the absolute up-to-date information, so you can effectively communicate to your bank what the exact position is, and have that open dialogue where you can say, look, these are the emerging factors. This is why I'm going to need finance. This is why my business is still going to be strong after or during this crisis.
I think maybe just to add, and Daniel and Paul have made the key points. I think just to add, what are your self-help levers? What are you doing within the company to address working capital, address OPEX, CAPEX? How are you changing your shareholder distribution policies? We've seen a wave of suspensions, cessations, cuts to buyback programs, to dividends in the UK. I think by and large, certainly the UK domestic portfolio managers, fund managers understand that. It hits their shareholder return numbers and clearly through the DPS numbers. But there is an understanding, particularly for the long-only community, that those actions need to take place. So the conversations with the lenders are very much going to be around your sources and uses of liquidity, waterfalling your position, understanding the stresses on those situations and what the prevailing assumptions are, and laying it out very, very clearly. And I think it's not a single solution. You got to think, how are we going to diversify this through the short-term paper, through direct bank lending, through, depending on size, scale, rating, etc., capital markets, private placement. How are we going to raise funds from our committed payables to help the working cap? There's a slew of options. Business cards, procurement cards. How can you put in place P card programs to give yourself more capacity on your DPO? Banks have seen a reduction in air travel on their corporate card programs. More than happy to explore discussion around virtual cards. Back to the technology point, there are solutions beyond the traditional general purpose loan book within the banks. And it was Daniel that said it first: have the conversation. Have the facts and have the conversation. As I said earlier in another question, needs are aligned. The banks have no interest working out and taking over on a recovery basis more companies than they need to, and it's absolutely critical that the earlier the better, really. And I think Daniel made the point also that there was this huge tidal surge in the first 4 to 6 weeks, and some of that's dissipated now. So the committees are better placed on a bandwidth and capacity basis.
Thanks for that, Mark. Just a question from our audience. We've had several come in over the last, whatever it is, 40 minutes or so. But I'm going to combine a few here because there seems to be quite a concern from our audience in terms of how much liquidity is actually available to the banks over the, maybe that's the next 3, 6, 12 months, depending on how long this goes on. At what point is this going to become a liquidity problem if such a thing was to happen?
I can have a first shot and maybe reverse the order if it's helpful. I think the thing for corporates to the 2 points that I would make in response to that is the banks enter this crisis, and that the banks are a big swathe, but the banking industry generally enters this crisis in a much better place. Tier 1 ratios, risk-weighted assets to equity, are considerably higher, 3-4 times higher than they were in 2007-8. So the buffers that have been put in place through Basel III, particularly for the bigger institutions that have countercyclical buffers, that have all the ratios that need to be adhered to in terms of liquidity coverage ratios, supplementary leverage ratios, are all of an order of magnitude better. And the second point I would say is that relative to our downside expectations, drawings on committed facilities have not hit those levels. And we are certainly, along with the vast majority of our peers, positioned to sustain those committed drawings, and have worked with our clients to access other forms of liquidity such that we're in a position that we are ready to support. And that's not going to be universally the case. And I say we as a community as opposed to the institution. But this is not something, I personally believe this is not something that's going to have, a single wave. And so a lot of the banks took the view that they need to reserve some powder as this thing pans out. And that is the product of experience, because you go in too big too soon. When the wave pulls out, you want to make sure you've got your board shorts still around your waist. So I think that's the key message from the institutions.
Yeah, I mean that was the learning from the last crisis, and effectively it's a lesson that's been very well learned by banks and central banks too. In the financial crisis was essentially a bank liquidity crisis that precipitated a capital and economic crisis. This is very much the reverse. We're not seeing any real pressure on bank liquidity. That's partly because as Mark said, banks started in a much better position. They had much stronger liquidity, much stronger forecasting and stress scenarios. But also in the last crisis, the central banks started on the back foot. It took them maybe a year to fully respond in some cases, and actually realize that it was a liquidity crisis rather than a bank capital crisis. What we've seen this time is central banks have literally started, they've come out of the starting gates in an incredibly aggressive fashion with regard to liquidity. They've put in place incredible levels of liquidity support. The Bank of England with its TFSME scheme, it is a typical example, and they've made all that freely available to banks, and we're not seeing any pressure really on bank liquidity at all at the moment, or we're not expecting any in the next few months.
And Paul, just as a postscript to that, I think the capital markets have helped enormously. We've seen a sort of 250% increase in year-on-year volumes. We had a series of firsts in March and April, from the longest period without issuance to the highest ever issuance in a single week to the highest ever issuance in a single month. And so the fixed income investors have really helped to take out a lot of these positions that the bank were taking on in drawn bridge positions, to again recycle that capital. And I think the central banks, through their liquidity windows where there's asset pledgeability by the financial institutions, is equally helping. But forgive me for following on your point, Daniel.
Yeah, I mean, I was really just going to echo the points colleagues have made in terms of the strengths of banks' balance sheets going into this crisis, and also just building on that, this is not simply banks saying that is the case. The Bank of England and the FCA and the PRA test this extremely vigorously and regularly, and have done an enormous amount of scenario analysis as the crisis has unfolded. So the FPC report last week did a very detailed look at the bank's ability not only to withstand potential credit defaults through this crisis, but continue to make credit available throughout a prolonged scenario, and a pessimistic scenario of what a crisis might look like, and actually, perfectly comfortably take a hit of up to £50 billion and not even touch half of the capital buffers. Now, obviously, that's not a situation that the banks want to face, but it does demonstrate that not only do the banks have the strength of the balance sheet, but they're very, very robustly tested by the Bank of England and the PRA to ensure that is the case. And I think the FPC's report last week validated that, and importantly went beyond saying the banks were in a strong position to withstand the exposures they already have, but through that to continue to make credit available to businesses as they require it. And I think, as Mark's mentioned before as well, the incentive of banks to do that, it is not an incentive. There's no incentive for banks to curtail credit either to businesses or indeed to personal customers. And the interconnectedness in terms of the potential defaults is well recognised in the industry. So there's a critical incentive for the banks to continue throughout what is probably going to be a very difficult year for the banking industry in terms of the hit it is likely to take in terms of exposures. But it has the capacity to withstand those and continue to make credit available. And all of that is very, very robustly tested and very regularly tested by the authorities to validate that.
And Daniel, Brian, okay, just before we conclude on that point, I mean, an example of that is in 2014, the ECB put in the long-term refinancing operations effectively to issue, fresh capital to the banks, to issue fresh loans to the corporate sector. So these measures are now, 5 years plus seasoned. And I think there is a strong precedent fact pattern for central bank support to ensure that the banks have the means, as again, back to the earlier point, to execute the monetary and the fiscal policy and the macroeconomic requirements of their respective jurisdictions and societies.
Okay, because it sounds to me that this is certainly an anxiety for lots of people, that the debt mountains potentially are building around the place, and they just want to have some reassurance that this is going to be in some way sustainable. And I totally agree with you, Mark. We're in a completely different situation from back in 2009. Totally different situation. But I suppose it's a case also of the banking sector is a lot more, nimble this time around, having potentially been stung quite hard all those years ago. We tend to remember our pain. Yeah.
Yep. Well, resilience doesn't mean load up on debt. It means be ready for the next stage of whatever we're dealing with.
Yeah,
and it also just sorry, Brian. I was just going to call out very quickly some of the work that the Citi UK has started to do, and I think some people will have seen the Times this morning article on the letter that they sent to Andrew Bailey, setting out some of the work that the private sector has now started to do around expanding equity capacity within UK PLC to respond to that question around the debt burden that many of these businesses have taken on. There's now a recognition that there's probably going to need to be some sort of public-private collective effort to make sure that there's equity capacity in the system as well for those businesses that require it. So debt's been very, very important in many cases for the emergency response, but equity will be equally important for taking us through the medium to long term.
Yeah, Paul.
Yeah, I mean, just again to echo the anyone thinking that this is the 2007-2008 crisis is a World War I soldier fighting a World War II battle. It's not. Banks are not on the front line of this crisis. They're in the supporting role, which is the role that they want to play in the economy. This is going to be a crisis very much focused on employment, on potentially property, and debt. But banks are there essentially to support businesses in what they want to do, and support businesses that are well run and robust. So I would say to our audience and treasurers, focus on your business, focus on your your suppliers and your the customers that you sell to. Make sure you know those. Make sure you know your business. Make sure you're in good shape, and then look at what financing facilities are appropriate. And the bank will be there to provide them, because, as I say, this is banks in the supporting role in the economy, which is a much better place.
Okay, thank you, Paul. Well, we've run out of our time, so I'm going to say thank you, Paul. Thank you, Mark. Thank you, Daniel. A very engaging conversation. Well, I thought so. I hope the audience agrees. And thank you to the audience for taking the time to actually log into this as well. Just to remind you that there is a feedback survey at the back of this. Please do fill it in, because, like I said at the start, we try to make these things better and better as we go through it. There is also a virtual discussion forum that you can continue the conversation in. And as I said earlier, all these conversations are going to be recorded. So if you want to go back and remember who said what, it's all going to be online. So thank you very much.
Thank you.
Okay.